minus 3,005 points. That is the staggeringly historic drop we all just witnessed from the Nikkei on Friday. It is a massive number, and it begs the biggest question we are all asking ourselves heading into Monday. Is this relentless selling going to continue, or will some sanity finally return to our markets? Hello, everyone. Welcome back to AI Market News. Today's explainer is all about how our markets are attempting to stabilize after the rout, and why the upcoming jobs report is the absolute decider for what happens next. Let's take a collective deep breath and look at the damage. As you can see in the chart, that massive red candle on Friday is impossible to ignore. The Nikkei literally posted its third worst single-day drop in history, effectively erasing weeks of hard-earned gains in just a few hours. But to truly understand this domestic crash, we actually have to look across the Pacific to a cascade of events coming out of the US. Based on available data, 3 specific Wall Street catalysts landed incredibly heavily on Tokyo's Friday session. First off, OpenAI's reported mega IPO delay to 2027 severely hurt SoftBank Group, crushing that whole AI narrative we've been tracking so closely. Then, Apple hiked their product prices, instantly sparking underlying consumer demand fears. And the final blow for us, reports that Samsung and SK Hynix are planning multi-billion-dollar investments, which triggered immediate panic about global memory supply. Now, for all of us trying to understand the sudden panic in semiconductors, let's briefly unpack the underlying mechanism of memory oversupply. Basically, when massive new production investments are announced, it fundamentally increases the total future supply of chips. If that newly created supply outpaces actual consumer demand, chip prices fall sharply, which directly hurts sector profits. This was the exact opposite of the bullish supply constraint narrative that had been driving our market euphoria just days earlier. But here's where the narrative shifts slightly for the better. The graph shows a comparatively calm Friday evening session in the US following Tokyo's crash. The NASDAQ closed down only 0.24%. This muted follow-through was absolutely crucial for us. It essentially broke the panic cycle and gave Monday's Tokyo session some much-needed room to breathe. And that breathing room translated into cautious stabilization. As you can see in the chart, Monday's intraday action was a total roller coaster, but it actually held the line. After falling heavily by as much as 1,300 points right at the open, short-term futures buyers aggressively stepped in at the lows, pulling the market back from the brink into a much more stable holding pattern. What is truly fascinating about Monday's session is the internal market divergence. According to current market information, nearly 70% of prime market stocks are actually rising. Let's emphasize that. The vast majority of the overall market is up. The drag is heavily concentrated in the recently surging AI and semiconductor names that are now facing steep corrections. Giants like Advantest, SoftBank, and Kioxia remain under immense pressure, while consumer and gaming stocks like fast retailing and Konami are moving notably higher. The pain is highly localized for us right now. Let's turn our attention to the currency markets, which are telling their own story of pure anticipation. The graph shows the USDJPY, locked in an exceptionally tight holding pattern, restricted to a microscopic range between 161.72 and 161.87. It is the textbook definition of a market holding its breath, just waiting for the next major signal to drop. In fact, short-term yen volatility has hit its lowest levels in recent weeks, and that 162 intervention ceiling remains completely intact. The underlying mechanism here is all about risk management. Institutional traders are refusing to make directional bets or push the currency past that 162 line right now because they need a genuine, undeniable macroeconomic catalyst to justify the risk of triggering government intervention. Until they get that data, they are perfectly content to just sit on their hands. Which brings us to the ultimate decider for our next market move, Thursday's U.S. non-farm payrolls, or NFP. For us watching the markets, this is essentially a binary event. Will we see the bull case or the bear case? A strong NFP means yields go up and 162 is firmly back in play. A weak NFP means yields go down, and we could very quickly be testing the 160 level. Let's break down exactly how this chain reaction works so we are all on the same page. If the payroll data beats the prior 172,000 consensus, markets immediately price in higher odds for a September rate hike. That expectation pushes Treasury yields up, which strengthens the US dollar, driving the USD/JPY dollar-yen higher. Conversely, if the jobs number is weak, it unwinds that rate hike pricing, yields dip, and the dollar sinks. That would serve as a massive relief valve for both the yen and equity volatility across the board.
Looking at our economic calendar, the timing this week is incredibly compressed, adding a serious layer of urgency for all of us. All eyes are on Thursday, July 2nd for that crucial U.S. June NFP release. Immediately after that data hits, U.S. markets will effectively shut down for the Friday, July 3rd, Independence Day substitute holiday. And meanwhile, in the background, we have an ongoing, looming catalyst, the formal Samsung and SK Hynix investment announcement.
As we navigate this compressed week, we all need to closely watch the scale of that upcoming Samsung announcement. If capital expenditure is as massive as rumored, semiconductor corrections might continue straight through the holiday weekend. Thanks for watching. Please subscribe and hit the like button. This video was automatically generated by NotebookLM AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below. But let's leave off with this thought. If the U.S. jobs report entirely rewrites the interest rate narrative on Thursday, will these targeted tech sell-offs suddenly look like the ultimate buying opportunity of the year?